On January 29, 2025, Tesla stock moved 7% in a single day. The company didn't cure cancer, it didn't invent teleportation, it released a quarterly earnings report that most Wall Street analysts called mixed, and yet billions of dollars changed hands in minutes. If you're wondering why a car company that makes fewer vehicles than Toyota behaves like a tech startup crossed with a religious movement, you're asking the right question. Here's what's strange. Ford sells more electric vehicles in Europe than Tesla. General Motors has higher profit margins on trucks. BYD manufactures more EVs globally, but none of them can sneeze without their stock barely moving, while a single Elon Musk tweet about Dogecoin can send Tesla shares on a roller coaster. This isn't about cars anymore. It never really was. Traditional automakers are valued on something called a price-to-earnings ratio. It's simple math. Take the stock price, divide it by annual profit per share, and you get a number. Ford's PE ratio sits around 6. Toyota's is about 9. These are companies the market treats like appliance manufacturers. Reliable, boring, predictable. Tesla's PE ratio has hovered between 50 and 100 for years, sometimes higher. In 2021, it hit 200. You're paying $100 for every dollar of profit the company makes. That's not a car company valuation, that's a bet on the future. Wall Street values Tesla like a tech company because it sells a story, not just vehicles. Autonomous driving, energy infrastructure, AI robotics. The narrative is that Tesla isn't competing with Ford, it's competing with Google and Amazon. And here's the uncomfortable part. The narrative matters more than the numbers. When Tesla misses delivery targets, the stock might drop 5% for a day, then recover within a week because believers buy the dip. When Elon promises full self-driving is 6 months away, again for the 8th year running, the stock climbs. This creates a feedback loop. High stock price lets Tesla raise cheap capital. Cheap capital funds ambitious projects. Ambitious projects feed the narrative. The narrative supports the stock price, round and round. But here's the tension. Tesla's 2024 profit margin was around 8%. That's good, but not exceptional. Apple's is 25%. The company still makes most of its money selling cars, not software or energy. Full self-driving remains a feature that requires constant driver attention, despite its name. The Cybertruck launched years late. The robo-taxi fleet that was supposed to revolutionize transportation by 2020 doesn't exist. And yet, the market cap is larger than the next 5 automakers combined. What you're watching is the financialization of faith. Tesla moves markets because millions of retail investors treat it like a proxy bet on technological progress itself. It's not just a stock, it's an identity. Online communities analyze every delivery number, every supercharger installation, every Musk interview like scripture. Short sellers have lost billions betting against it, which only reinforces the true believers. The danger isn't that Tesla is overvalued or undervalued. The danger is that price has become completely detached from underlying business fundamentals. When sentiment shifts, there's no floor, just air. So Tesla doesn't move markets more than profits because it's special. It moves markets because we've collectively agreed to treat it that way. The question isn't whether that's sustainable. The question is what happens when the story stops growing faster than reality.